Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Crillo. Today we have Dr. Jason Balara. He is a CEO and co-founder of Lark Capital Group. His focus is on impact-driven investing through multifamily real estate and small business acquisitions within the Lark Veterinary Impact Fund. Prior to starting Lark Capital, Jason was a single-family home investor with a construction background, focusing on small multifamily rentals and fix and flips. Lark Capital is currently invested in over 700 multifamily units in Atlanta and Phoenix, as well as a student housing development in Maryland. Lark Capital has also owned over 400 self-storage units in coastal Mississippi. Additionally, Jason founded a construction company and is an experienced veterinarian surgeon and hosts the Know Your Why podcast. A lot of stuff there, Jason. Thank you so much for being on the show today.
Yeah, thanks for having me, Charles. It always sounds a little daunting when you start to read all of that, and I'm sure people think, well, what does any of that have to do with anything else? But thanks for having me on.
Yeah, no problem. No, I always like to kind of set the stage of what we're talking about so people know that your background and kind of where you're coming from, because everybody has an interesting story of how they arrived or how they work along with real estate investors. So that's kind of what we get to. But prior to you getting into real estate investing, can you tell us a little bit about yourself, both personally and professionally?
Yeah, sure. It all kind of ties in. I was, grew up, two kids were in a single mom. We didn't have a lot of money. We moved around a lot. So I very quickly learned, I saw home ownership as like the way out of that. And so that was something that was with me from a young age. Also, I was a kid who really liked animals. And so it sounds silly, but those two things really ran parallel. I would say I was in real estate before I was a veterinarian. I started in construction as a teenager. Started as soon as I could. I bought a house that was a fixer-upper. I just saw that as the way to kind of get out from where I grew up. But I grew up in Massachusetts, and the winters are harsh, as I'm sure people know. And so going to veterinary school in my mind kind of got me away from doing construction outside during the winter. I never envisioned that I would move to Southern California, where I live now, where you don't really have to worry about that weather problem. But anyway, that was actually a pretty big part of that decision-making process. I then focused on my veterinary career for a while, but I was still all along doing a lot of live-in fix and flips. So I'd buy a house, fix it up, live there for a couple of years, and then kind of do that over and over again. And so really those two careers ran parallel most of my life. And it wasn't until 2020 where maybe it got a little bit different in terms of the focus. So that's the background in a nutshell.
Nice. Yeah, it's interesting how helpful having some sort of real estate construction background or any type of contractor background is to being a better real estate investor. The amount of information I've learned from looking over other contractors and handyman's backs and talking to them about how things are built, especially when you're dealing with older houses. Myself, being a New Englander as well, originally from Connecticut, so dealing with a lot of old properties as our first properties that we invested into before moving down south here to Florida. But it's one of those things that you learn so much, and these lessons I've just kind of you bring with you throughout it. So having that, because I think one of the most difficult things or biggest mistakes that people make, that I definitely made, was when I started investing in real estate, was my expenses and my budgets would be way off. You know what I mean? And it just you just don't understand what stuff costs. You don't understand how long stuff takes. You don't understand all the things, and having some sort of background or some sort of knowledge just makes you a better real estate investor.
Yeah, I agree. And I mean, honestly, when I sort of made that shift into multifamily, really what drew me to it was the value add strategy and the ability to use my construction background to be impactful on the properties that we own. So it was, it's a piece of the puzzle. It's a piece of real estate ownership. It's not the only piece, but it's what I know and what I'm comfortable with. And so I felt like that was an area that I could really have an impact.
Yeah. So you bought a house. It was a fixer-upper. Let's talk about your first true real estate investment and kind of what you did, what you were doing, and kind of how that moved into what you're doing today.
Yeah. So probably the first, I still consider that first house as a fixer-upper, really truly an investment. I saw it that way. I've actually always seen it that way. I'm sure my wife could speak to that quite well, and that we don't buy nice houses. We buy rundown houses and make them nice houses. And so she's been through that a few times with me. But I would say maybe, if you want to look at it from a true investment perspective of where I had tenants and stuff like that, I bought a 3-family in Roslindale, which is a suburb of Boston. So that was, I was 24, maybe. That was when that happened. And so that was probably the first step into, it was definitely the first step into something bigger. But I still lived in it. I lived on one of the floors, fixed up the house, like in general, and rented out the other 2 apartments. So that was probably the first, more than where we lived. I mean, we lived in that, but more than just our own single family house. And then it was 2020 when I shifted into larger scale multifamily and self-storage that you mentioned.
Nice. Yeah, my first one was a house hack as well. So lived on one floor, rented the other one, and then bought another 3-family probably 2 blocks away from it or something. So it was my first kind of foray into learning real estate. And it's a great way, house hacking is a great way of getting into real estate little by little. You know what I mean? So you only have a couple tenants. It's not too crazy. You know what I mean? You're never going to get super overwhelmed, but like you learn stuff and you start like finding people and contractors and handymen to assist you. Much different than just being dropped in, not really know what you're doing in a 20 unit or something like this. And you're kind of like, kind of swimming to stay alive in there.
Yeah, totally agree.
So let's talk about what you're doing now. Can you explain kind of your current investment strategy and what the Lark Veterinary Impact Fund is?
Yeah, we formed that fund in 2023, sort of at the urge of a mentor of mine. We had been through. I started investing in multifamily in 2020 and 2021. We acquired 3 properties late 2021 and early 2022. Everybody knows interest rates went up a lot and quickly, and that certainly impacted us like it did other people. So sort of drew back on the acquisition side of things a little bit and started really focusing on operating those properties and trying to, kind of ride out the storm. One thing I noticed was my own deals and some of the deals I had invested in passively, a lot of the distribution stopped. So we had gotten to a point where we actually had like a fair bit of passive income. I'm not one to go in lightly. I sort of, once I discovered this path, I invested pretty heavily both in our own deals and outside deals, other people's deals, in an attempt to sort of create this passive income that everybody wants. And then a lot of it went away. A lot of people paused distributions, and so I had a veterinary business at the time, my surgery business, that had kind of been, it wasn't a side hustle, but I had never really marketed for it, right? It was all just word of mouth. And then I realized, well, here we are. We need to kind of figure out a way to bring that money back. And so we actually started ramping up the surgery business. And what I realized was, and I'm sure this coincided somewhat with some of the stuff I was seeing on social media, but I realized that in a business, I had the ability to pull levers faster and implement change faster in terms of increasing revenue, increasing customer base, things like that. If you own, say, a 200-unit apartment, what you really want is stability. You hope to not have all of those people turn over. Your rates are very dependent on the market. So with our surgery business, we just went out and started marketing. We added on more and more customers, if you will. And so I saw that as, hey, that's a meaningful difference between business acquisition or business ownership and real estate ownership. Just a different strategy. Both are good. And so I at first thought, I'm going to do this. I'm going to buy businesses for myself, my family. And then I kind of had the idea, well, can I do this for investors? And then, like I said, I had a conversation with a mentor, and she said, you should start a fund. And so what I decided to do is to see, could I make a fund that had real estate as well as small business ownership in it? Turns out you can. Talk to the SEC attorney. Turns out you can do that. So we set that up, and that was kind of the I would say the next iteration of Lark Capital was centered around that fund, continuing to manage the assets that we already owned, but really looking at it now through the lens of, hey, what had we gone through over these last couple of years when the market shifted? What's more important to us now. And so looking at real estate as a long-term prospect, not a ton of cash flow in at least in the markets that I was investing right now, but we could take small businesses that throw off a lot of cash flow and combine them together for our investors. And now you have your sort of steady cash flow from the businesses, and then also add in the appreciation that comes from those real estate, sales over time. So that was kind of the concept around the fund. And I didn't really want to do a fund unless it was based on some sort of principles or impact or something. And so that's why it is called that. And we donate 25% of the profits to Not One More Vet, which is an organization that supports veterinarians there's an unfortunately high suicide rate in the industry. So it's an organization that's dedicated to helping with that, helping people that are struggling. And so we kind of attached ourselves through this fund as a way to sort of give back to the veterinary community that I'm a part of.
When you're purchasing practices, are you purchasing the real estate is really a third-party apartment buildings that are with it, or are you buying the retail spot that the businesses are in, or can be either or?
Yeah, and I think that maybe I probably did not name this fund correctly from a marketing perspective. We purchase multifamily in terms of real estate. It's still multifamily real estate. And the businesses don't necessarily have real estate attached with them. So we have purchased an electrical company. We have an office that we work out of, but we don't even own that office. So the goal was actually diversification and to not necessarily have them tied together. I would consider buying a business that comes with it, real estate, but that wasn't kind of the main focus there. So it's a sort of like a dual track within the fund.
Interesting. Yeah, I mean, if you're buying businesses to keep them is cash flow, let's say heavy, you probably don't want to be buying the properties as well going with it. And if they expand, then you have now another problem where you can't usually expand out every person's property, where it's much easier just to go and find another lease and build that out versus buying and selling. You know what I mean? Again,
it's very much essentially what's the best use or the best allocation of that capital? Is it in the real estate that goes with that business? Are you gonna sort of hamstring yourself by saying, I only want businesses that come with real estate? You're probably going to miss out on a lot of good opportunities that way. And so it's to me, the fund became very much about being opportunistic. And that's a big driver of the deals that we would look at.
Yeah.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carrillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
Yeah, it's great because with real estate, especially with multifamily apartments that I've invested into for decades, it's something that they're not always, the cash flow is very minimal, especially in the beginning. And it's really a wealth growing business. Everybody sells the passive investing kind of dream side as a thing, but it really should be a side thing. It's really a wealth generation kind of asset and a wealth holding asset. And, the passive income is an additional thing after you've held it for many years. You know what I mean? That's where the passive income really starts. It doesn't start in year 1, 2, or 3. And when you're speaking to investors, and you kind of know that because if you're speaking to new investors, which you probably have this conversation with often, and they're wondering when they're getting their first payout or what, we're buying a business, we're disrupting this business, we're doing a value add. You're going in, we're changing around this business. There's not going to be as much income coming in, if anything, that we can distribute right away. And so, but that's something that people have seen online and they think, oh, you buy it and it just starts coming in the month later. You know what I mean? So, but let's talk about what you're doing. Like, what kind of properties are you buying now through your fund? What are you focusing on in those? I think it was 2 MSAs you're focusing on. Is that correct?
Yeah, we've been mainly focused on Atlanta and also Phoenix, Arizona. And the Atlanta is where the bulk of the properties that we own and operate. It's a great market. It's big. Generally, rents are below national averages, so it's still comparatively affordable rather than other cities. Phoenix is similar. I see a lot of similarities between the two places. In the Phoenix deal that we have is actually through a partnership with one of my mentors, the same mentor that advised me to create a fund. So like I said before, my strategy truly is opportunistic. So I look at a lot of deals. I would say at the moment, I have not seen a lot in the real estate space that looks super appealing, especially when I put it up against what we can get in the business world. It's a very different strategy of underwriting and kind of expectations. And so my focus has shifted. I live in Los Angeles. I actually like the idea of potentially starting to add some assets here locally, but smaller. Mostly because buying a 200 unit in Los Angeles would not be something that I have the investor base or my own capital to get into. But you can do very, very well with something like a 6 to 20 unit local assets in California. And now that I understand, people talk a lot about the landlord friendliness of a particular market. And now that I understand kind of how those dynamics can play out, an example is, we've run up against some challenges in Atlanta because the counties, nobody was prepared to deal with the aftermath of COVID, right? Like nobody knew what to do about that. So it's not necessarily, but some of the challenges that have come from that have really impacted whether or not it has truly been landlord friendly. And so some of the rules and regulations that you expect, if they don't happen, well, now that really has a big impact on your business plan. And so my theory now is, okay, well, in California, we know there's rent control. We know that it's not necessarily a landlord friendly state, but we know those things, right? And so if you can build that into your business plan, you're prepared for it and you can kind of address it appropriately. So I think it's just a matter of understanding what your local rules and regulations and how that will impact your business plan in whatever asset class you're dealing with.
Yeah. Atlanta was hard hit with obviously the backlog of evictions going through there. We have a property outside there. Actively, I have some passive investments in Atlanta. And then the second thing was that we got hit hard with a lot of tenant fraud too. And I don't think those property managers were ready for that. And that's a different thing. But yeah, as you say, it's true. Some states that tout themselves as being more landlord friendly might be less so, and it might be easier. I mean, I've spoken to a lot of investors, or a handful maybe, that really focus on rent control, and it's very interesting. One mainly I met years back at a conference, and that's what they all focused on. They would focus on rent control properties. They knew the laws. It was in New York City intricately, and they could navigate them. And so it's a property that most people wouldn't like, but if you know how to work with the tenant base, how to work with the city, and you have the right legal team, it can be a niche.
Yeah, exactly. I mean, the reality, I mean, hear a lot of this, like, people again on social media, like, I live in California, but I would never invest here. And it's like, people have made a lot of money investing in California, whether that's in real estate or in businesses. People have made a lot of money. You mentioned New York City in real estate. Like, I'm from Boston. Like, people make money in real estate in Boston. It happens. So it's maybe it's more challenging, but also guess what? Like, the bigger the challenge, usually the more money you can make. Like, they're high appreciation markets. If you're willing to stay in them for a while, the cap rates stay low. We had a lot of cap rate compression in the Sunbelt states in 2021, 2022, but then quite a bit of expansion back to maybe what was the norm, but cap rates stayed low in California and New York and New England, and so it's kind of like to me it's just understanding what challenge you're going to find challenges no matter what you invest in, whatever whatever entrepreneurial path you take. So what are the challenges that I'm actually facing and what can I do about them? Like what in California, rent control doesn't really start until it's 15 years old. So if I want to build 6-unit apartment complexes, I don't have rent control, right? For 15 years, I can put in, I can essentially don't have to worry about that. So you have a product that you can build, and I'm not doing that right now, but lots of people are and making a lot of money doing that. So it's just there's many examples of how you can manage these particular challenges.
Yeah, it's going to take a different investor too that's going to be interested in it, usually because they're not going to be getting those large, as we were talking about before, those large, passive investor dividend, and distributions coming out to them. It's going to be much smaller. But in these markets, they're very appreciation heavy, as you said. You know what I mean? So throughout the tri-state and then throughout Southern California.
Yeah, exactly. You might, again, you go back to that development deal example. You might put your money in. It takes 2 years, 3 years for the builder to complete the project and get it leased up. But then you might get back 2.5, 3 times, what you put in at the end of that, that's a great return. It's just you didn't get anything along the way, and you just have to understand that that's what you probably got was tax benefits. And so for some investors, that's what they want. That's a big piece of their investment strategy. So it's just understanding like what your goal is, and if you're truly want heavy cash flow, you might want to invest in the Midwest, or you might want to invest in businesses, or what I'm sure there are other asset classes that have are more high cash flow but not big appreciation plays. So it's just a matter of kind of understanding what your investment thesis is.
Yeah. And the last thing too about the 15 years is that in some of these areas, especially Southern California, as I understand it, it's very difficult to build. So with the difficulty of building, you get that 15 years, it's like developing a new drug, right? Now you have that so many years where you can just kind of cash out on it. And the thing is that you're doing it from having to work through everything, all these different years of getting something built, and all the people that you're working with much more difficult than other parts of the country. So now you're going to have immediately the appreciation. You're going to have this higher cash flow that you don't have to really worry about for 15 years with the rent control. And then the other thing too is that, when you sell it, it's a huge appreciation play.
Yeah, no, absolutely. And it creates a moat, right? Mm-hmm. Like you exactly. have, everybody's looking for that moat in business. And it's like, if you're willing to take on those challenges by investing in certain markets or certain asset classes or whatever, like you essentially increase the value of your investment by just making it harder for other people to do it. And so it's kind of like, you kind of just pick your hard, right? It's like everything's a little bit hard in business. Like just pick how you want that to work for you. And so everybody has a different strategy there.
So after purchasing a number of different properties, 700 plus multifamily units, self-storage units, there's always unknowns when investing in multifamily properties or real estate in general. I mean, how do you plan for those when you're in the stages of doing due diligence and when you're ready to pull the trigger and actually purchase a property?
That's a great question that I don't know that I even know the answer, because I think there are a lot of unknowns. I will say my ideas on kind of what's most important during those processes have maybe shifted a little bit. One, I would say and maybe this was me being naive, but the debt structure is probably the most important thing of all, right? Like the bank is your biggest investor in your deals usually. And so you have, I don't want, I'm okay with adjustable rates, but I kind of want, I want some safety built into that. But ideally I want long-term stable debt. I don't want as much leverage as I might have used to think was a good idea. And I want to know that lender has a good reputation for working with people if things go bad. And so that lender has whether you know it or not, they can have a very big influence on the deals. And so a lot of times, if everything goes well, you don't know that really because everything goes well and you're paying your debt service and there's no issues. But it's when you start to run into issues, and we saw those things during when the interest rates were rising quickly. There were a lot of lenders that were not very friendly to investors, and we had it in our deals. I've had friends that have had those challenges in those deals. I have a friend who had a deal go bad. The bank wouldn't work with them. It went into receivership. Now the property is far worse off than it was. So like the investors lose for that lender being, ultimately stubborn and not willing to work with the operators. So I think that, I'm rambling a little bit, but really like the importance of that debt and the debt structure cannot be understated, and you're figuring that out in due diligence to some extent. Also through your relationships as you grow your portfolio. I would say the other part that I think has maybe come to light is delinquency. When you're looking through your due diligence, the delinquency, truly what is the delinquency? It's a thing that I think can be masked somewhat. And so you really want to dig in there. I personally, now in terms of leasing out units, I like the idea of working with a program like the guarantors or one app guarantee or something to protect yourself on the back end. We've implemented, you mentioned the fraud, and maybe Atlanta has been heavily hit more so than other markets, but we've implemented so many different things on the front end to try to screen for fraud, and it still happens far more regularly than it should. So then putting in some sort of essentially insurance policy that if that person has to be evicted, you haven't just lost on, however, because the eviction process is supposed to take 45 days, I think, in Atlanta, and it often takes 3 months, but it was taking 6, 9, 12 months. And so that's a lot of lost revenue, but can be recouped. And so I think it's just a lot more about backside protection, I guess, is the theme here on what I'm speaking about.
Yeah, a couple different things. When you're talking about the debt, and I found that very interesting, I was thinking about it, is when I've ever spoken to older mom and pop investors that have owned their properties for many years, no one tells me, oh, I've got this. It's 95% loan to value. You know what I mean? It's always like, there's nothing on it. There's 20% loan to value. You know what I mean? Like, as people get more experience as investors, they start throttling back the debt loan to value. And I just I've never met anyone. I've never met anybody like, oh yeah, we just got this 100% refinance. You know what I mean? It's like, it's anything like that. It's always like less debt and more cash flow, less hassles. You know what I mean? Kind of a thing. And, that's kind of how real estate works. You buy it, you hold it. And, in 10 years or something like that, you're supposed to see all this cash flow and this wealth generation, but you're not supposed to over leverage. And people, when they start getting cute and trying to hold properties for a year or 2 or 3 years, and then something jumps up, or all these type of kind of acrobatics they do, this is where they get them in trouble, I found over the years.
Yeah. And I would say this applies to the small business acquisition side of things too, because you can get an SBA loan for up to 90%, which is fantastic from a returns perspective and a cash out of pocket perspective, but also it's a 90% leverage. So like, you really have to look and see like what could go wrong, what realistically could go wrong to make it hard to pay that debt service if I go 90%. And so these are just debt's a fantastic instrument, but you have got to use it smartly and know what you're getting into. And the SBA loans are personally guaranteed. So, this is there's a lot of things that you'll see out there, and it's like, look, you can buy a business for only 10% down. You sure can. But is that a good idea? We were all buying real estate in 2021 at 85% leverage. Was that a good idea? No. In hindsight, it was not a good idea, but it makes projections look better when you do it that way. And so it's just kind of like, I hope that investors, passive investors, active investors, that we've learned a bit of a lesson about looking at just whatever the projection is for a return percentage and just going for whatever the highest one of those are. So I think it's, you got to take the hard times and just learn from them. That for me, that's the only way that makes it kind of worthwhile.
Yeah, who would have known Dave Ramsey's not crazy? So it actually makes sense when we do it out.
Right.
So you're talking about going through harder times here with everything with the debt servicing going up. Let's talk about with the value add business plan that you might have during a stagnant market, because this is always like a hit and miss, because when we start going through something, we would like, oh, we're going to do 3 or 4 units per month, and now you're like, we're going to do 1 or 2 months. Units per month, and we're kind of see how everything kind of works. How do you guys really approach it when you're going through a stagnant market, or how did you? Now stuff looks like we're going to be getting a little bit positive cash flow in some of these markets or increases in rents this year. But how are you doing previously when stuff was tightening up?
Yeah, I would say we changed, and this is going to have to do also with just your, like, specifically your market and the class of your asset in your neighborhood. But I think we definitely dialed back the scope of our renovations, right? So, when we first bought, it was like, oh, let's go in it. We're going to turn this into this, turn this Class C property into a Class A property via construction. And they looked beautiful. And it was like, we put washer dryer hookups and like, we put washer dryer hookups in probably 25% of the units at a property. Not one person ever had a washer dryer that they put in those units. And so you really have to tailor your scope of work to your resident profile. And you might be able to upgrade your resident profile a bit, but you can't move where it is. And so the reality is, we talk a lot about location in residential real estate. I think it's equally important in commercial real estate. The valuations are a little bit different, but at the end of the day, like, people want to live where they want to live. And so I think it matters. But to answer that question directly, Charles, I mean, I think it was a big piece of let's change kind of where we allocate our renovation and our value add budgets. And I still think the exteriors and common spaces, we didn't change a whole lot there. It was still like, you want this place to look nice when you drive up to it, or have pride of ownership when you live there. But maybe you're not replacing all the floors and replacing the counters with granite every time you turn a unit. We certainly stopped putting in washer dryer hookups because they just weren't getting used. And so it's kind of, you have to take the cues from your resident base and the applications that you're getting. And I think maybe my mistake on this was to think that we could influence that too much just by making it a really nice place, right? Because it's still in the same location. So I think you have to really look at that. And thankfully we learned that lesson along the way and kind of shifted our strategy. But regardless of the market being stagnant or growth or whatever, I think you still probably need to be pretty conscious of this in terms of what, where you're putting that budget from a construction standpoint.
Yeah, I would see plans come through, or people have performers come through with their business plans, and would say, the quintessential kind of grill, barbecue, fire pit. I'm like, man, people are tightening their belts. They're not really worried about barbecuing outside with the fire pit is their number one thing. You know what I mean? So maybe make sure that the roofs aren't leaking. Maybe make sure that, like, we're doing clean and painting kind of turns, and focus on that and get people in there that need a place to stay where their rent's not getting jacked up. So, but Jason, you're being a doctor. It's one thing I found raising money from a lot of professionals over the years. And it sometimes can be a little difficult explaining the kind of the benefits of real estate investing with highly educated people like doctors and attorneys. How have you successfully done that with working with and raising money from doctors, other than you being one yourself?
Yeah. I guess I think just being transparent. I think being as realistic and transparent is the best way. Like, these are, doctors are highly educated people, at least in the medicine space, right? But a lot of them, and myself included, like, early in my veterinary career, I that's what I spent time on. I didn't think about money. I didn't think about, kind of where were my investments going to go? And so it's something that they haven't spent a lot of time on, and they're used to knowing a lot about what they know about. And so when you start to come at them with something that they probably don't understand very well, it doesn't feel good, right? Like it doesn't feel, they're like, oh, you want me to put my money into, my money that I trained for 12 years in, and I worked very hard to get to this point. You want me to trust you to give you my money to do something I don't understand. And I think that's where like the transparency comes in. People that come from a finance background, they're like, yeah, of course, this is what we know. We know about investing. We know about private equity. We know about syndication, all of that stuff. But I don't think those were not things that ever came up in like the veterinary world and doctors in other fields of medicine. Same thing. They're like, this is not familiar territory to me. Now, some of them take an interest to it like I did, and it became a big important topic for me, but there has to be some kind of reason why that becomes a big interest to them as well. So I think it's just being real transparent. People like to talk about the tax benefits of real estate investing, but most of the time, like your doctor, they might make a lot of money. They can't use those tax benefits against their W-2 income, but I think people give the impression that you can. And so it's just about being really transparent and again, for me, it was like having some understanding of it myself. You can't use those tax benefits against your W-2 income, but you will get to use them when there's a capital event. So it's not like you don't get them at all. You just don't get them in the same way that sometimes shows up on social media.
Exactly. It's funny because I think as an entrepreneur, you're kind of a little bit more used to not being the smartest person in the room. You know what I mean? If I have an issue with legal, you talk to your attorney. If you have issues with taxes, you talk to your accountant, and you're really just kind of putting all these pieces together to make something work. Whereas I think attorneys and medical doctors, they're used to being the smartest person in the room. So like you said, it's kind of like, yeah, the transparency is a big thing, because obviously if people just go through the same adage and book and kind of PowerPoint that everybody's been given over the last several years about investing in real estate, a lot of it's not true or doesn't really connect with their situation. So that's a lot of great information there.
Yeah. And it all looks the same, right? Like if you don't understand it, it all looks the same, like the same, everybody's shooting to get in this, IRR window or multiple. And so it's like it's almost like the deals select for whatever the market thinks the right amount of return is right now. And so it's like you have to kind of look past that and look to the people that I would say, have some experience, and that are just, telling you real information. It shouldn't sound too good to be true, because if it does, it probably is.
True. So Jason, tell us a little bit about your podcast, Know Your Why.
Yeah. So that was, funny enough, next week, 500th episode comes out. This will probably come out after that, but, early March, 500th episode comes out. That Know Your Why is something that, it came from me when I was getting into commercial real estate more heavily in 2020. I just listened to a lot of podcasts, and the mechanics of real estate is not that different. Like it's, you can hear the same things over and over again. But what really resonated to me was the why behind what people were doing. And that, so when I would listen to a podcast episode, that was what would draw my attention the most. And so I said, well, I guess if I'm going to do a podcast, I want a podcast where that's largely the focus. Like I have guests come on and they're, what do you want me to focus on? What's the angle? What's your avatar? All of this. And I'm like, you're the focus of this interview. I want people to know you and why they should be interested in what you're doing. And so, and I guess also it just comes from understanding my own why very strongly as being a driver behind, what I've done over these last, probably my whole life, but I didn't know it was called a why before 2020. So it was, you just have things that influence you in life and make you keep pushing when it's hard. And so that's really what the podcast is about for me. It's real estate inspired, but I've had life coaches, business coaches, business owners, fitness professionals, like just really people that have a drive that comes from something maybe just more powerful than themselves.
Okay. How can our listeners learn more about you and your business?
They can go to our website at larkcapital.com. They can email me directly, jason@larkcapital.com. You mentioned the podcast is the Know Your Why podcast. We've been lucky to have a lot of really great guests and successful people. And anything. Also, my name is Jason Balara. There's not another one, so Google works pretty well. It's not a common name, so I think that's you can find just about anything. And if you happen to live in the Los Angeles area and need an electrician, our electrical company is 154 Electric. So please connect there. That would be great. But yeah, anyway is pretty. I'm pretty easy to find.
Okay. Well, thank you so much for coming on today, and looking forward to connecting with you here in the near future.
Thank you so much, Charles. Appreciate having me on.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.